Good afternoon and a warm welcome to all seminar attendees. We are delighted to have you all today with us. I have the great pleasure of introducing our seminar today. The research seminars in finance, economics, and banking are a joint organization by the FEBRAN and the Financial Management Association International. We are very pleased to have with us today Professor Lucio Sarno, Professor of Finance at the University of Cambridge, and he will be presenting his research on value and momentum leftovers. If you have questions or comments for Professor Sarno, please use the chat Q&A box, which is located below on your screen. We'll pass the questions at the end of this presentation as time allows. So the presentation is expected to take 50 minutes, and then we have 10 minutes to share your questions and comments. Professor Adam Zaremba from MBS School of Business, France, and Poznań University of Economics and Business in Poland will moderate the seminar today. Without further ado, I pass it on to you, Adam.
Thank you, Cesario, and good afternoon, everyone, and thank you for joining us. It's my pleasure to welcome Professor Lucio Sarno to this seminar series. And let me first briefly introduce our speaker today. So Professor Lucio Sarno is Professor of Finance at Cambridge Business School at the University of Cambridge. And he's also Professorial Fellow at Girton College and Research Fellow at the Centre for Economic Policy Research in London. His previous academic roles include Vice Business School, so formerly CAS, University of Warwick, University of Oxford, Columbia University, as well as Singapore Management University. Outside academia, he was also the Director of Currency Research and AXA Investment Managers, and he also advised diverse major institutions worldwide, including IMF, European Central Bank, Federal Reserve, World Bank, Bank of England, and I could enumerate here many more. Research-wise, Professor Sarno specializes in international finance, asset pricing, and largely currency markets, with his works being published in over 100, he published over 100 papers in all the top-tier leading journals, including Journal of Finance, Review of Financial Economics, Financial Studies, Journal of Financial Economics. His works have been also widely covered in all the major media outlets like Financial Times, Wall Street Journals, and New York Times. And currently, he also serves as a senior at the Senior Advisory Board of the Italian Ministry of Finance, as well as the Council of Advisors of the Hong Kong Institute for Monetary and Financial Research. So without further ado, Professor Sarno, the floor is yours.
Thank you very much, Adam and Cesario, and everybody else involved. It's an honor to be part of this, to speak on this series, which I follow myself, of course. So today I'm going to talk about a recent paper on value and momentum. It's joint work with two PhD students here in Cambridge, Brandon McBride and Bo Yuan, and with my long-term collaborator Gabriele Zin at the Bank of Italy. Let me also say the paper is not online yet. It will hopefully be available publicly later this month. But hopefully the slides I will present to you are going to be perfectly consistent with the online version you will find available in the coming weeks. So the paper is focusing on a long-term issue in asset management. So value and momentum, as you all know, are two of the most important pillars of the asset management industry. They have been so for over a century at least. And so I refer to value as the simple notion of building an investment strategy where we buy assets which are undervalued and sell assets which are overvalued. I refer to momentum again as the simple notion that we design an investment strategy where we buy assets which have performed well in the recent past and we sell assets which have performed poorly in the recent past. So those strategies have been used for a very long time. The academic literature starts, of course, in the case of value with Mears-Statman paper, and then, of course, Fama-French. Whereas with momentum, really, the academic literature starts with the analysis of Jagdish and Titman, and then Cliff Asness in a variety of papers and his own PhD thesis. And so what we know is that value and momentum, they are both profitable strategies when assessed in the data over long periods of time. And they are not just profitable in equity markets or US equity markets, which is where typically strategies are tested for the first time, but they are profitable in other developed equity markets in the EU, in the UK, in Japan, and they're also profitable in other asset classes, not just equities. So they perform well in bond markets, in FX, in foreign exchange, in commodity markets. So there is a vast body of evidence that documents this. Nothing new from me to say on this issue. One important characteristic of value and momentum, which for a long time went unnoticed, is that they are also negatively correlated. And so they provide returns which are negatively correlated, which of course is very interesting from an asset management point of view, because it means that combining the two of them provides diversification benefits. That point is made very clear, very convincingly in a paper by Asness, Moskowitz, and Pedersen. I'm going to refer to them as AMP. In a paper in the Journal of Finance in 2013, which is quite central and got us to think about these issues in a different way. What AMP do is they document the power of this negative correlation and the power of combining value and momentum strategies across different markets, different geographical location, and across different asset classes. And they show that once you combine value and momentum, thanks to this negative correlation, a very simple, naive combination, 50-50 combination, generates a much more powerful investment strategy with a Sharpe ratio of 1.45, which of course poses an important challenge, a difficult challenge to people working in asset pricing in order to understand what are we compensated for when we are receiving or generating these returns. Indeed, the cross-section of these portfolio returns based on value and momentum constructed by AMP are very difficult to price. And no conventional model is able to do so. That's why they have to form their own model, propose their own stochastic discount factor or pricing kernel to price these assets. And indeed, their model does a lot better than others. And it's a simple model based on three factors, which are, not surprisingly, world equity market factor, the MSCI World, say, and then a global momentum factor and a global value factor. Okay. Now, with this vast literature in the background, why are we revisiting this literature? Well, let me illustrate our motivation using a couple of graphs. I'm actually going to start from this graph. So what you have here is the standard scatter plots we look at when we do asset pricing tests. On the vertical line, I have the actual average returns on 48 portfolios sorted on value and momentum. And on the horizontal axis, I have the model implied or predicted expected returns given the AMP model. Okay, you can see the model does pretty well. 66% are square, and there is a clear tendency of these actual returns and the model implied returns to move together. But what I also learned from these results is that the GRS test, which is the standard test we do to test whether the model is fully pricing these test assets, tells me that the model does not fully price these test assets. There is alpha left on the table. There is a part of these returns which is, or excess returns, which is not explained by the model. Okay, so that's a full sample of 40 years going from 1983 to 2023. And if I split it into two and I just look at the last 20 years of data, there is that's the same story. Okay, the R square is still roughly the same. but basically the model does not fully capture these returns. Indeed, I can say after their paper, there were other attempts, but there is no model out there at this point in time which can price this very demanding cross-section of portfolios on value and momentum. That's one part of the motivation. The other part of the motivation comes from this. So what you have here is the Sharpe ratio constructed recursively and rolling for the 50-50 combination of value and momentum constructed in the way AMP do. And by the way, I'm very thankful to Cliff Asnes and his co-authors for sharing the updated version of their data directly to me and then making them available publicly. And so what do we see here? We see that there is a general downward trend in the Sharpe ratio of this 50-50 combination. There are two vertical lines here. The first vertical line splits the sample in half. The second vertical line indicates the point where the sample of the data used in the paper by AMP in the Journal of Finance stops, okay? And so what we learned from this is the Sharpe ratio in the first half of the sample is huge, is 171. The Sharpe ratio at the end of the sample period used by AMP is 1.47, which is very similar, very close to what they report in their paper. But at the end of the sample, it goes down to 110. So there is clearly a sharp decline in the second part of the sample. And if you look at the rolling Sharpe ratio constructed on a 3-year window, it's even more apparent that then in the second part of the sample, this strategy has not performed particularly well. So there is a breakdown in this little table of what the Sharpe ratios are for the subsamples, basically 1.71 for the first half, 110 for the full sample. For the second half of the sample is only 0.44. And if you construct the Sharpe ratio just for the 12-year period following the publication of their paper, it's only 0.21, okay? So in essence, what we know from updating this data is that first, there is alpha left on the table. That we knew already. It's documented in the paper by AMP already, and it continues to be a feature with the updated data. Second, the Sharpe ratio of this combination, 50-50 combination, is deteriorated in terms of performance quite dramatically in the last 10 years, possibly 20. And so the questions, there are many questions that arise from these results, but the ones we address in this paper are the following three. First, what is the stochastic discount factor that can actually price fully this joint cross-section of value and momentum portfolio excess returns? How does that look like? Second question, once I have that optimal SDF, how does the tangency portfolio implied by that SDF perform? Does it show the same deterioration over time, or does it perform strongly throughout the sample? And does it perform so strongly out of sample? Third, since the first two questions are going to be addressed using latent factors, I'm also going to ask a question, what are the real drivers, the macro financial drivers, the sources of risk, if you want, that underpin this latent factor SDF and generate the returns that we're going to derive with this procedure? Let me tell you what the answer to those questions are. Number one, the optimal SDF that prices fully that cross-section of value momentum portfolios requires 9 common factors, 9 common latent factors. That's what's necessary to ensure we leave no alpha on the table. Second, the Sharpe ratio of the tangency portfolio implied by that SDF is 1.47 with no alpha left on the table. The performance of that tangency portfolio is strong also out of sample. In fact, out of sample, that tangency portfolio from the optimal SDF performs even better in relative terms relative to the 50-50 combination. And this performance originates from 4 components. And we can decompose the Sharpe ratio into those 4 components. The components are obviously the value traits, the momentum traits, the average correlation component, in a sense, the gain from exploiting the average correlation between value and momentum, the diversification benefit. And also, fourth, there is a large gain from combining freely value and momentum test assets, in other words, from modeling them jointly from the outset, as opposed to modeling them separately and then combining them. Okay? And we can document exactly what is the relative importance and the attribution of these four components. And the last one, which has been ignored so far, is going to account for a third of the overall Sharpe ratio. Finally, we're going to also show that we can relate these latent factors to a small set of macrofinancial drivers. And so there are many macrofinancial factors which are priced with this SDF, but we can replicate essentially the information in the SDF with a small set of macrofinancial variables which can themselves price the full cross-section of value and momentum portfolio returns. So that's those are my claims, and I'm now going to try and persuade you that I have evidence to back up these claims. I will not talk about the literature, which is gigantic on both value, momentum, and on the asset pricing of value and momentum. I will, however, spend about 10 minutes or so talking about asset pricing methods. So one reason why we are able to address these questions the way we do and in a sense, provide the answers that I have listed to you is that during the last 10 years, and so after the publication of the paper by Asnes and co-authors, we've made tremendous progress in the asset pricing literature. So for many decades, asset pricing research was troubled by at least two problems. One is omitted variable bias. Essentially, we were testing models which we were writing down in a reduced form fashion most of the time. And of course, we don't know ex ante if you are missing a factor or not. So all models are misspecified potentially. And that omitted variable bias has been a problem throughout this research, which we found difficult to overcome. Second, measurement error bias. When you're using in these reduced form models factors which are non-tradable in particular, then we know they're measured with errors, which is going to generate again problems in estimating their risk premia and reaching clear-cut conclusions on the ability of a model to price a certain test assets. So several papers have addressed these questions. My favorite is this paper by Giglio and Chu, published in the Journal of Political Economy in 2021. They propose a very simple three-pass methodology that tackles fully both sources of this bias, and which is very simple to implement. So that's the way it works. First of all, you have a set of test asset returns. In our case, it's going to be the panel of value momentum portfolios. And so assume that there is a small set of latent factors, let's say K, that captures the systematic component of this panel of test asset returns, okay? And we extract these latent factors from the data. Then I'm going to run 3 steps. Step 1 is just like the first step of our make bet with latent factors. So I run time series regressions of the test asset returns on the latent factors, and I estimate this psi, this exposure to risk, okay? Second, I run a cross-sectional regression of the average returns on the test assets on these exposure to risk that I've estimated in the previous step, and that allows me to estimate gamma, the price of risk of these latent factors. Third, I can now estimate the risk premium on any candidate factor very simply by running a regression of any candidate factor, let's say consumption growth, for example. I run a regression of consumption growth on the demeaned factors and the coefficient, and I estimate the coefficient eta, which tells me exposure in a sense of this candidate factor to the latent factors. And then I can obtain a consistent estimate of the risk premium on consumption growth in this example, simply as the product of the vector of the risk factor, vector of the risk premium times the exposures to those risk premium for that factor. Okay, and that estimate of the risk premium is now immune to omitted variable bias and measurement error. Indeed, I've cleaned up measurement error, and if I have done so, I can also construct a clean version of my candidate factor. So I can take consumption growth, and and I can construct a clean version, a denoised version of consumption growth, simply by multiplying the factors times those exposures. That will give me consumption growth free of measurement error on the basis of my SDF. Now, this procedure requires only one thing, requires to get started a set of latent factors. And Zhiliu and Chu use PCA, principal components, as most people do, which is of course based, applied to the covariance matrix of returns, which you see now on the screen. However, we are not going to use PCA to extract the latent factors. We are going to amend the procedure, and instead we're going to rely on the risk premium PCA developed by Letau and Pelger in a couple of papers in the RFS and the Journal of Econometrics, which is just a generalization of PCA. Specifically, it's based on this objective function, where there is this omega term, which is called a penalty term or a risk premium weight. Now, if omega is equal to -1, then we are exactly in the case of PCA. If omega is positive, what this objective function does is that instead of just selecting factors on the basis of their ability to fit the time series variance, the time series variation, so the second moment in the test assets, is also going to put some weight in minimizing the cross-sectional pricing error. And so you can think about that objective function as an objective function where there is potentially a trade-off between pricing, between capturing very well the time series variation and so reducing the idiosyncratic variance, and minimizing the cross-sectional pricing error. Okay, and so as we increase omega, we put more and more weight on the first moment, so minimizing cross-sectional pricing error, and that's the trick in a sense that this procedure uses to efficiently detect factors which might be weak, might be not particularly important in terms of explaining the time series variation of the test asset returns, but they could be high Sharpe ratio factors, factors that matters a lot in the SDF. So essentially what we're doing is we are merging, we are augmenting the Zhiliu and Chu procedure by using the Letau and Pelger procedure to estimate the factors at the outset. We call this the augmented three-pass procedure. It's not entirely novel because it has been used in a previous paper of mine with Gabriele Zin and Federico Nucera in the RFS. But other than that, we are going to use standard criteria to identify the number of factors. So we're going to look at how we're going to decide how many factors we need in the model by looking at things like how well do we capture the time series variation in the data, how low are the cross-sectional pricing errors, and how high is the Sharpe ratio of the tangency portfolio implied by the SDF, and how are the alphas zero. Ultimately, we want the model to fully price the cross-section of baryon momentum, and therefore we want the alpha to be zero. So we're going to be testing that too. The model is an unconditional model, so it's a linear SDF, standard linear SDF. So in sample, the tangency portfolio of the mean variance frontier are just going to be given by the factors times the loadings of the SDF, and those loadings are simply given by the mean of the factors, the vector of the mean of the factors times the inverse of the variance covariance matrix. That's in sample where we are using the data fully to conduct our analysis. In our auto-sample exercise, so obviously we proceed in a recursive fashion, only using available information at time t in order to forecast the factors next period. So that's all about methods. The data, as I said at the outset, are the same data as Asnes et al., but updated directly by Cliff Asnes and Andrea Frazzini and others at AQR, for which we are very grateful. It's a cross-section of 48 test asset excess returns, 24 for value, 24 for momentum. We have just below 500 observations in the time series. And there are, as I said, there are 48 test asset returns because we have, they're formed, the portfolios are formed using tertiles. There are 8 markets or asset classes because we have 4 stock markets, US, UK, European Union, and Japan, and 4 asset classes, international equity indices, foreign exchange, fixed income, and commodities. So that gives us 48 portfolios of value and momentum excess returns. I won't talk much about the macro financial candidate factors we use in the last part of the data, but essentially we have lots and lots of factors available to us, which we use. We categorize them for convenience into different themes, different categories, financial uncertainty, liquidity, crash risk, macro interest rates, and so on and so forth. But I'll talk more about this once I get there. Okay, we can now start to look at some results. So the first result to look at is this. So I'm going to focus for the rest of the talk mainly on omega equal to 20, but just for this slide, I'm going to show you also omega equal to -1. So omega equal to -1 is the case of PCA, okay? So if I use PCA, basically, you can see with 10 factors, okay, with 10 factors, I get a Sharpe ratio of 0.76 from the tangency portfolio of this SDF, okay? And I can see from the next table that if I test whether there is alpha left on the table with those 10 factors, with 10 factors, I have still got about 24 or 22 alphas, which are statistically significantly different from 0. So I'm nowhere near pricing these test assets, okay? I can tell you that I need at least 20 factors to get anywhere, okay? So now you can see why I use omega equal to 20, because with RPPCA, the results will look very different. And indeed, you can see here, as I increase the number of factors, you can see that several of these factors have a statistically significant risk premium, not all of them, but the first, the fourth, 7, number 8, and number 9 have a significant risk premium. The Sharpe ratio is now with 9 factors only, 1.47, which is double the one I had with PCA with 10 factors. And more importantly, when I look at the test whether there is any alpha left in the test asset returns, the answer is there is none. Okay, the number of significant alphas is 0 already with 8 factors. It's not clear I need a 9th factor. 8 factors appear statistically to be sufficient to price fully the cross section. So why do I keep 9 if 8 are sufficient for that purpose? I keep 9 because you can see the tangency Sharpe ratio, when I include the 9th factor, increases from 1.42 to 1.47. The 9th factor indeed is a risk, as a significant average excess return. It has a significant risk premium. And so it makes sense to us, given that the loading on the SDF is quite large, 0.22, to include the 9th factor. I'd rather err on the side of caution and having more factors than having too few. Okay, but so the bottom line is the optimal SDF that fully prices the cross section requires 9 latent factors, and you can see here some scatter plots of the goodness of fit with 4 factors, 4 latent factors, 7, 8, and 9. You can see how, as I move to larger models, I get closer and closer to the 45-degree line. I get to an R-square, which is almost 100%. Okay, that's a cross-section of R-square. Now, data analysis was fully in sample, using the full set of data. We then ask the question, is the factor structure of these 9 factors stable over time? So here is some evidence on that. So what you have here is, for all factor models, 1 factor, 2 factors, 3 factors, and so on, we calculate recursively the Sharpe ratio of the tangency portfolio implied by the model. And you can see here how it's almost like there are three blocks. There is a block which is around this Sharpe ratio of 0.6, another block around the Sharpe ratio which is above 1, and then a block which is in a Sharpe ratio around 1.6. Okay, and so effectively, what I learned from this, by the way, I'm using the first 20 years of data just for the first estimate, and then we are recursively estimating the Sharpe ratio from that point onward. You can see that basically the gain from having a model with at least 7 factors has always been there. It was there from the outset. Okay, so the model was never very parsimonious. Okay, the only thing one might say is, up to some point around 2014, 2015, somewhere around here, the gain from having the factors 8 and 9 was probably rather small. But in the last sort of 6-7 years of the data, you can see the 7-factor model the Sharpe ratio is deteriorating quite a bit, whereas the factor, if I add the 8 and the 9th factor, you can see the Sharpe ratio is much more stable. Okay, and overall, I would say the stability, the factor structure is very stable, but the relevance of these 8th and 9th factor is particularly important in the last part of the sample. Now, with the same recursive out-of-sample procedure, we can also calculate Sharpe ratios out of sample and see how they change. Obviously, we expect them to deteriorate. So essentially, what we are doing is we are starting from the first 20 years, and we are estimating the loadings up to time t to predict factors at time t plus 1, and then constructing an out-of-sample pricing error at time t plus 1. So the tangency portfolio is formed using the mean variance weights up to time t. Okay, and let's look at omega equal to 20 and the 9 factors, and you can see the Sharpe ratio is about 1.07. So this is just for the second part of the sample. Sharpe ratio 1.07. I would regard that as very satisfactory. Remember, the Sharpe ratio of the 50-50 combination in the second part of the sample was just 0.44. If I use mean variance weights, it's slightly better, it's 0.66, but fundamentally, that's a vast improvement. In a sense, the deterioration we saw at the outset of this talk is not apparent anymore. If I have this fully specified SDF, which takes into account all of these leftovers that were not being priced by the SDF of Asnes et al., that allows me to generate a strategy that performs very well by combining value and momentum optimally. Another out-of-sample test we do is, instead of sort of going through time on the same test assets, we test the model on a different set of test assets. Now, of course, they have to be value and momentum test assets, so we look at Fama-French portfolios sorted on size and value or size and momentum. So this is a scatter plot for the results on size value, Fama 25 size value portfolios, an R-square of 55%, and the alpha is 0, the p-value is 0.5. Okay, so there's no significant alpha. Size momentum, 25 portfolios, again, no significant alpha. If I put all of them together, 50 portfolios, I can price all of the Fama-French portfolios, is no significant alpha left over, even though size was never part of my test asset returns. Now, I'm not claiming this latent factor is going to price everything, of course. This is designed to price value and momentum. That's really the claim we're making. We do then a lot of work to relate the factors of Asnes et al. To our latent factors and understand what is the differential in information between the two. So here, for example, you have some regression of the latent factors on the factors used by Asnes et al., the market, the everywhere factor, and the everywhere momentum. And the bottom line, there are lots of numbers in this table, but the bottom line is this, that of course the factors of the Asnes et al. Model are very often statistically significant and explain partly our latent factors, okay? So you can see R-squares like 92%, 79%, 27%, so sizable R-square. At the same time, however, when you look at the factors, the latent factors which are really important in pricing, in other words, the factors which have a significant risk premium, which are factors 4, 7, 8, and 9, you can see that there is alpha left on the table, okay? Significant. So there is information in the latent factors, in those latent factors, which cannot be captured by the factors in the reduced form model of Asnes et al. And the Sharpe ratios associated with those alphas are sizable. Even more compelling is the evidence if I ask the question, can I explain the tangency portfolio returns generated by my optimal SDF with 9 factors with the Asnes et al. SDF or the Asnes et al. Factors? And the results are here. Let's look at the 9-factor model. That's what we're interested in. And so in this row where my mouse is, and you can see that the 3 factors of A and P are all statistically significant and positive. The R squared is 42%, so there is a clear relation, but there is alpha left on the table. It's about 7%, and there is a Sharpe ratio left over. Okay. In other words, in a nutshell, the Asnes et al. Factors capture some of the information, but obviously not all of it, and that's the information in these leftovers that matters for the fully pricing the cross-sectional asset returns and generating the performance and the Sharpe ratios I've shown you. Now, the next thing we do is we decompose this Sharpe ratio into 4 components. So the way we operate is this. So one thing which is different in our approach, fundamentally different, is that we don't construct first a value strategy, then a momentum strategy, and then we put it together. Instead, we start from the outset by modeling jointly the set of value and momentum portfolios. And so we use the full variance covariance matrix from the outset to estimate the latent factors. And so part of the value added must come from that. Now, how do we identify how much of that is contributing to the Sharpe ratios we are showing? Well, it's very simple. What we can do is we can use our same procedure just on value and so build an optimal value SDF, then build an optimal momentum SDF separately, and then we put them together with mean variance weights. If I operate that way, essentially the only difference is that I'm not exploiting fully the variance covariance matrix from the outset. I'm combining value momentum ex post. And so the bit I'm missing out is the ability to freely choose optimal weights and exploiting fully the variance covariance matrix across value and momentum as well as within value and within momentum. And so this gives us basically 2 components of the Sharpe ratios, the returns and the Sharpe ratio from our portfolios. It gives us a component which we can call spanned and one which we can call unspanned. The spanned component is the one which will include value, momentum, and their combination, constructed separately. And the other one is the residual. Okay, and that we want to know how big those are. So if I just don't use the optimal SDF on value with 9 factors, I have a Sharpe ratio of 0.99. Fine. If I do the same for momentum with a 9-factor SDF, I have a Sharpe ratio of 0.98. If I put them together, I have a Sharpe ratio now of 118. I have now some tangency portfolio returns. I can run a regression of my tangency portfolio returns constructed using the full joint cross-section at the outset, and this combined tangency portfolio which uses value and momentum built separately and then combined. What happens is that 0.97 of the Sharpe ratio, okay, let me put it this way. Our overall Sharpe ratio is 1.47 from our strategy, right? 0.96 of that is attributable to the spanned component, okay? So to value trades, momentum trades, and the combination of the two. 0.51 is the residual component. It's the unspanned component. It's the benefit from using the joint cross-section from the outset when we extract the latent factors, okay? So it's pretty important. It's about 1/3 of the Sharpe ratio. 2/3 of it is the span component, but 1/3 of it is just the benefit of modeling everything jointly from the outset. And you can see it here. This is the cumulative return series for the tangency portfolio return. The spun component is the red line, and the green line is the unspun component. The sum of the two is the overall return. Which means essentially operating this way and starting from the beginning, freely combining value momentum portfolios allows us to move to a superior efficient frontier. It allows us to move from a frontier which combines the Sharpe ratio value and the Sharpe ratio momentum in a ex post fashion. It allows us to move up here from 118 to 147. It's a significant, economically important gain. The final bit on which I'm going to spend the remaining sort of 7 minutes that I have is to talk about the third step of the procedure, where we try to relate macro financial factors to the latent factors more. So remember, the way we do that is we take any candidate risk factor, say G. I made the example of consumption growth at the outset. We regress it on the demeaned factor to get these exposures eta, and then we can estimate the risk premium. Now, we do two things in this analysis. We do it obviously with 100 or so risk factors available in the literature, but we also do something else. We use the returns from the spun and the unspun component, as well as the returns from the value momentum trades, to understand better their properties. So let me just tell you two things about this analysis. So here, in this case, G is the returns from a tangency portfolio built on some latent factor model. So RV, for example, these are the returns from the value strategy built using our procedure. RM is the equivalent using a momentum strategy. I'm highlighting this factor 4. Why do I do that? Because that's a factor where value and momentum have different exposures, both statistically significant, although the one for momentum is much bigger. Why is that interesting? It's interesting because factor 4 is the latent factor which almost entirely captures the negative correlation between value and momentum. Okay? And so that's a factor which is going to be very interesting because it's the factor where value and momentum are going to diverge, and that's where the negative correlation that we like very much comes from. Okay, so what drives that in terms of economics? I'm going to tell you that in a moment. Second, I can also do the same with the returns of the unspun part of the strategy and the spun one. Here, I just want to highlight one thing. The spun component of the returns, these are R square, is driven by the first part of the SDF, by the first 7 factors. The first 7 factors give me an R square of 80% for the spun component. Okay. On the other hand, the unspun component does not relate almost at all to the first part of the SDF. It relates primarily to factors 8 and 9. And so there is almost a clear separation. The spun component is the first part of the SDF. The unspun component is the second part of the SDF. And again, that helps us understand where to dig to look for these drivers and what they are. Now, in terms of risk premia of these hundreds of factors we look at, I am just going to say the following. I'm just going to make a general point. There are too many to look at. Out of the nearly 100 factors for which we estimate the risk premium, we find that 34 of them have a significant risk premium. In other words, 34 of these in the list are priced. Okay, it doesn't mean they enter the SDF, of course, because they are correlated. They can capture similar things, but it means they are priced relative to this SDF. Now, in order to estimate the price of risk, it's really important to have the 9-factor model specified correctly. In other words, if I have a model which is misspecified, so I have an omitted variable problem, I'm going to be quite likely, it's going to be quite likely that I estimate poorly the price of risk. This is not always the case, but it can be the case. So let me give you an example. Global financial crisis indicator. This is the Helen Ray and Miranda Agrippino indicator, which will turn out to be important overall in this analysis, actually. If you look at the pricing of the risk premium associated with that factor, with a one-factor model, I have a risk premium, about 13. And that risk premium doesn't really change very much at all if I use a two-factor, a three-factor model, or a nine-factor model. Okay, so if I had a misspecified model, I would get a pretty good estimates of the risk premium no matter what. Okay, but look instead at, say, term spread, the TRMS. If I have a misspecified model, I'm going to believe either that the risk premium is negative and insignificant, or I'm going to believe that it's -4 or -7. But if I have the fully specified model, I know that it's going to be -10. Okay, so this means I really need to deal with the omitted variable bias problem to estimate reliably and consistently this risk premium. Okay, now many of these factors have high Sharpe ratios. You can see it in the last column here. You can see very high Sharpe ratio associated with these factors, but there are too many to handle and understand the question, what really matters in the SDF. Why do I say that? Well, if I run univariate regressions of, say, the spanned component returns or the unspanned component returns or the total return on these factors, many of them will have a higher square and statistically significant coefficient, especially for the spanned component or the overall returns. The unspanned component is a little bit more difficult to understand. So how do I deal with this? Well, I deal with this by using a method that allows me to reduce the dimensionality of the problem. We use lasso. We use a lasso regression, very much like Kozank, Nagel, and many others in this literature, where we take these 34 factors which are priced, which have a significant risk premium. We run lasso to identify which factors survive and come out with a significant coefficient. That will give me a set of actually, by coincidence, 9 factors, which means I can now simply run a regression of the returns on from my tangency portfolio, from my optimal SDF on these 9 factors and see what they are and understand the relative importance of these factors. So here they are. These are the 9 factors that are needed. The names might not be self-explanatory, so let me tell you a bit what they are. A couple of them are related to interest rates, term spread, and the change in the long-term rate, 10-year rate. Several of them are related to hedge fund strategies, like straddles in equities and commodity markets. For example, GFC, the Global Financial Crisis Indicator of Helen Ray and Miranda Grippino, is also there. DTOI is a sentiment indicator based on trying to capture sort of over and under reaction in the equity market. And volatility. The EMV, this is a volatility indicator similar to this very difficult to pronounce JKP. It comes from Jensen, Kelly, and Pedersen data. They are basically capturing volatility in financial markets. So there is a group of variables related to interest rates, one related to sentiment, one related to crisis, and some related to momentum trades in trend following strategies in different asset classes and volatility. So a reduced form model built using just these variables, indeed, we can show price is fully the original cross-section of test asset returns. Why? Because, of course, it's designed to replicate the information in the latent factor model, which it does very, very well. And therefore, once I know the latent factor model, I can find a parsimonious model in reduced form, which using macro financial variables is going to price the original data. Again, I'm not claiming this is going to price every value momentum cross-section. Obviously, I can only identify these set of factors because I have a latent factor model. It's not obvious that if I use lasso from the outset, I could ever do that. Just one final word, because I think I'm running out of time. I just wanted to give you one more 30 seconds on that factor 4 that I mentioned earlier. as I say, the fourth factor is really important in terms of capturing the diversification benefit, the negative correlation between value and momentum. And so I wanted to show you, I wanted to tell you what that factor really relates to when we relate those factors to these macro financial risks. So what we find is that it's really related to the intermediary capital ratio, to measures of risk-bearing capacity, to crisis indicator, to the TED spread. So to variables which are really important in understanding times in markets when there is high volatility, possibly crisis mode, crash risk is very high. And those are times, of course, when value momentum behave very differently because momentum tends to do very well and value does not. And that's the divergence that captures that negative correlation. Interest rates also play a role in explaining that fourth factor. In a nutshell, because I think I'm running out of time, we require an optimal SDF with 9 factors if we really want to price this very demanding cross-section of value and momentum portfolio returns that Asnes, Moskowitz, and Pedersen have constructed. With 9 factors, we can eliminate all of the alpha. The tangency portfolio implied by that optimal SDF generates strong performance throughout the sample and without the deterioration that we see in the 50-50 combination. That is due to the methods we use and to the ability to extract factors from the joint cross-section of portfolios from the outset. Finally, we can relate these latent factors to a small set of macro-financial risk factors, which is nice because we can provide a clear interpretation of what factors really matter, what are the risks associated with this latent factor SDF, and what drives the negative correlation between value and momentum. And I think that's a good time to stop. And of course, I'm very happy to take any questions.
Yes, thank you. Thank you so much, Professor Sarno. Thank you for this insightful presentation. And let me now open the floor to questions. And to kick things off, let me maybe start with the first one. What would be the takeaway for practitioners from this study? I mean, we are talking about effectively building portfolios and trading across different asset classes, different markets. So the trading cost must be elevated as well.
So 2 things. First of all, let me say one thing about the point about transaction costs and so on, and then I'll be very clear about what is the takeaway for industry colleagues in industry. So of course, one thing we have not done in the implementation is to take care of costs and look at turnover, and so we don't provide net returns. But practitioners are much better than academics at really taking into account transaction cost and slippage and things of that sort to translate these returns from gross to net. So what is the takeaway? The key takeaway is twofold. Number one, the value of combining value and momentum as ideas, as pillars of an asset management strategies is as powerful today as it was 100 years ago. Okay, so one might be worried when they've seen that value has not done so well in the last decade, or that the 50-50 combination of Asnes et al. Has not performed so strongly in the last 10 years after the publication of their paper. One might be worried that those results were very sample specific and those ideas are no longer valid. Clearly, this tells you that's not true. Those ideas are perfectly viable as they've been for many, many decades. Second, the key learning point is we do have a standard way of operating in the academic profession, but also in many parts of the industry, where if we have 2 separate ideas, we deploy the first idea, and so we build a value portfolio, and then we deploy the second idea and build a momentum portfolio, and then ex post we combine them naively most of the time with a fixed rule. And what this exercise and this analysis is telling you is that the inefficiency of operating separately on those ideas can be very, very large. I can't say that it's very large always, but it's certainly very large in this context because you can see a third of the Sharpe ratio arises because of the gain of using the full set of test assets from the outset when you extract the latent factors. And so if you work across asset classes, if you invest across asset classes and across markets, why not doing so throughout their process as opposed to doing it just ex post?
All right. Now, thank you. Now, moving to the next question, let me maybe combine a couple of questions here. Now, could you reiterate how was the optimal number of factors obtained?
Yeah.
So how do we come up with this number of 9? And related to that, like given so many factors and relatively low number of assets that we are trying to explain and higher squares at the same time, do we run here into some risk of overfitting and problems with generalization of your findings out of sample, for example?
Yeah. So that's why the recursive analysis is really important and going out of sample is really important. Okay. That's important exactly for the reason. Now, so essentially, you can the number of there is no fixed rule to choose the number of factors, okay? But we have some requirements. There is no when I say there is no fixed rule, what I mean is that the desirable features of the models are many. I want to have a low unexplained time series variation. I want to have low cross-sectional pricing errors. I want to have a higher square. Above all, I want to have a high Sharpe ratio, and I want to have no alpha. So there are so many different metrics of evaluation that I can look at. Now, we look at all of them, but clearly one important constraint is that I cannot have any alpha. If I have alpha in there, clearly the model is not fully explaining these returns. So the test for alpha must be telling me that there is no alpha left. And that tells me the minimum is 8. Okay, the minimum is 8 because with any less than 8 factors, I still find alpha. The ninth factor, so the only question is it 8 or is it 9, and is it too many? Well, it's certainly not too many because any less than that means I'm not fully exploiting the returns available to me. Now, I'm leaving money on the table from an asset management perspective. Okay. And the ninth factor is questionable. One can have a discussion. Should I have it? Should I not? But I think leaving out a factor which has a significant risk premium and contributes to the Sharpe ratio strikes me as reasonable because it's unlikely to give me overfitting. Okay, it's unlikely to give you overfitting. And we know that 9 factor has been important in the last part of the sample, not in the early part of the sample. Okay, we know that the 9 factor is adding value in the last 5 years during COVID, say. And so that makes me even more convinced that I should have it. If it was a factor that mattered 20 years ago, then I might conclude, okay, maybe it's never going to surface again. So the number of latent factors is telling me, yes, there is commonality across these test asset returns, but they're also very diverse. And if I want to capture the systematic component, I need something much richer than the usual 3-4 factor models we use.
Right. So if we still have time, let me proceed with one more question at least. Have you considered applying this SDF ability to span other cross sections like profitability, investment factor?
So we have not. Now we could do that. So I think the methods are generally applicable. Now, taking the very same SDF derived from value and momentum, using it on a cross section which is using different characteristics to sort the portfolios, I am not too hopeful, I have to say. I'm not too hopeful. It might work for some, but in general, I'm not too hopeful. And the reason is that usually, at the end of the day, the information in that SDF is information that comes from the test asset returns. Those test asset returns are sorted on value and momentum. So I wanted to be able to price value and momentum, not just on my test assets, but maybe on different test assets, maybe in different countries, maybe in other asset classes. But should it price things which are sorting on completely different concepts? I doubt it. In a sense, this SDF, I view it as an SDF designed to price just value and momentum. But we could give it a try. We haven't done so at this stage.
All right, thank you. There's one very specific question. Do your factors relate to the PCA-based level, slope, and curvature factors of Clark in any way, Clark 2022?
We haven't thought about it in those terms, in the sense that so we think about the slope, level, and curvature when we think about the term structure of interest rates, and where obviously the extraction of latent factors is achieving exactly that, to try to capture those three components of the term structure. So what we can say about these factors is the following. The first factor is a level factor. It must always be. Every time no matter if you use PCA or RPPCA or any other procedure, the first factor is going to be super strong, and it's a level factor. It's basically the market. Okay, all of the other factors are slope factors. All of them. Okay, they're all slope factors which with different combinations of portfolios and different levels of strength. And so no matter how many factors I extract, what I will have is one level factor and a set of slope factors. Those slope factors tend to be the most important one for pricing, because they are the factors which have the two features I need for pricing, which are a significant risk premium and a big loading in the SDF. And so it's those load factors that tend to matter for the pricing.
All right. Do we still have time for questions, Cesario?
Depends on Professor Sarno if we can take
I
one
am
more.
happy. I
One
am
more.
happy to answer more questions.
Last
I'm
one,
not in a
because
hurry.
the compromise is to finish at 3 p.m.
Yeah, let me read this question directly. Can I interpret the latent factors as an aggregate of information from interest rates, volatility, etc.? Assume that this is the best thing you can do to assign some economic rationale what such factors represent. This is slightly different to your 2024 RFS paper, where you explore a large cross-section due to the cross-section of assets that you're trying to price.
Yeah, absolutely. This is exactly the way we interpret it. So, in a sense, what we're doing, so ultimately in asset pricing, ideally, where you want to get, so there are two ways to think about asset pricing. I could think about the ultimate goal as being, I want to know the SDF. Okay. And some people would say, once I know what the SDF looks like, I'm done. I don't need to know anything else. Now, that's true if you're using with macro variables or economic variables. If you're using with latent factors, I need to know what's behind the latent factors. And so you're quite right. With the way we interpret it is the latent factors do a really fantastic job at aggregating the degree of co-movement across these test assets. But in a sense, I don't know what they are. But I know they're related to a lot of things out there, movements in interest rates, inflation, volatility, illiquidity, and so on and so forth. And there are some kind of linear combination of these things. And so in a sense, breaking down the problem the way we do, I think has the following advantage. Using an optimal latent factor SDF, we are always going to be able to price any cross-section. Okay. And so we know how, what is the information at that point that fully prices the assets we're interested in, but we don't know the economics of it. Now, the economics comes in step 2 when we relate it to macro financial factors, because then we can find out what is the relative importance of those variables, because they need to explain the latent factors. And so in short, yes, the interpretation is exactly what you provide. And unlike the RFS paper with Federico and Gabriele, where we looked purely at FX markets. Here, instead of looking in a sense at the asset pricing of an asset class, which is FX in that paper, here we are looking at the asset pricing of the strategies. Okay, so in a sense, very often in asset pricing we focus on either pricing U.S. equities or foreign exchange. Here we are focusing on pricing strategies, no matter where they are.
Thank you very
Thank you.
much. On behalf of myself, Adam, and FEBRN and FMA International, we really thank you for having the time to be with us today. We know that the working paper is coming out very soon, so we have a gentleman agreement that will be in the FEBRN research paper series, and then we disseminate in our 10,000 subscribers. And thank you very much once again to bring your research to us. And I know your busy agenda, and it was not easy to find a date, but fortunately we were able to do that. Thank you as well to Adam Zaremba for moderating the seminar today. Thank you very much.
My pleasure, and thank you to all of you for the great service you're doing to the finance profession with your virtual seminar series. Thank you.
Thank you very much. Thank you.
Bye-bye.
Cesario.